seconds to get themselves out of the waiting room and into the webinar. So bear with us, and we'll be kicking off now in about 10 or 15 seconds time. Brilliant. There we are. Hopefully everyone has made it across. So very warm welcome. Good afternoon, and thank you for joining us today. You're probably aware we've run a few different webinars today. We've done one focus on the charity sector, one on our housing association sector, and then this final one is on commercial businesses. So hopefully, if you're on this webinar, you're more than welcome. A lot of the content will have been the same across all three. So if you have been on one of this morning's webinars, you're not going to learn a great deal new this afternoon, but the examples and the ideas are going to be more focused on commercial businesses rather than the not-for-profit sector. So the aim is hopefully we're going to take about 45 minutes, maybe a bit less, because we've probably got a bit less to cover today for the commercial sector to look at the impact the accounting change is going to have on businesses, and then we'll have some time at the end to answer some questions. So quick bit of housekeeping before I start. Because of the numbers on the webinar today, we're not doing sort of live Q&A. But if you do have any questions you want to ask as you go through, hopefully on your screen down the bottom, there should be a Q&A box. It's a sort of a speech mark with a question mark in it. And if you click on that, you've got the ability to type in a question. So if you've got any questions as we go along, please type your questions into that box. And when we get to the end, myself and Llinos will do our best to answer those for you. I say if there's anything we can't answer, we are recording the webinar today, and the plan is that we'll try and get the answer for you and then send the answer and the question out along with a copy of the slides and the recording when it's all done. So that's the sort of the quick introduction. Reason we're putting these webinars on, just so everyone is aware, is because of changes to the accounting standards. So you'll see on the slide there, we talk about FRS 102, and we've got a mixture today of accountants and business owners on the call. So I think I'm going to have to try and explain what a few things are. So FRS 102 is essentially the accounting rules that most of our companies in the UK use to prepare their accounts. There's broadly two options most companies have. You can either apply what's called IFRS, which are the International Financial Reporting Standards. We do a number of clients' accounts under those formats. Generally, they're the companies that have got overseas parents. But for the majority of UK businesses, they opt for FRS 102. And the people who set the accounting rules update those standards on a 3-year basis. So every 3 years, they have a look at them and decide whether or not to change them. So they did it 3 years ago and didn't change much at all. So, we wouldn't have done a webinar because there wasn't anything really worth talking about. But this time, there are a couple of big things that are going to have an impact on a lot of clients, which is why we've decided to put this webinar on. So to give you a bit of heads up as to what's going to change. So, as you can see there, the plan is to run through what those changes are, talk about some of the practical things you need to be looking at doing now, as well as, some of the, to give you a heads up as to what the change is going to be. But just to warn you, there's some quite detailed technical stuff that, will need to be looked at some point. We're not going to have time to go through all of that today. So today's aim is really to give you a high-level view as to whether these changes are going to impact you and your organisation. And then if you are, you can hopefully plan to put a bit of time aside later in the year to look at what you need to do to get ready for them. So I'm going to start off before I hand over to Llinos, because Llinos is, there's two main things. The first is revenue recognition, which Llinos is going to cover. The second is lease accounting, which I'm going to touch on. But I thought we'd start with just talking about the effective date that these changes come in. So the effective date will be the first year end you have after the 1st of January 2026. So for anyone who's a sort of a March year end, for example, your effective date is going to be the 1st of April 2026. But in real, in practical terms, it means these changes will affect the year ends from 31st of December 26 onwards. So it's going to be 2027 that we're worrying about these things. But as I said, we thought we'd better put this on now, because if you are impacted, you may need to start preparing certain things well in advance. You can early adopt. So if you had a burning desire to give yourself some more work for your current year end or the next year end that's coming, you could do it for your December 25 or your March 26 year ends. But I don't think I've spoken to anyone who wants to do that yet, and we wouldn't necessarily recommend it. unless there was a real benefit to you and your business. So as I say, these things are a little while away, but there are certain things which, if it is going to impact on you, you probably need to start preparing it for sooner, particularly if you do budgets in the business. If you're preparing budgets for the next year, you may want to factor in some of these changes now so that your final year-end accounts don't vary too much from your budgets. So yeah, that's all I was going to do by way of introduction. So at this stage, I'm going to hand over to Llinos, who's going to take us through the main changes from a revenue recognition point of view. So over to you, Llinos.
Thank you, Harry. So Section 23 brings in a fundamental shift in how revenue is recognised under FRS 102, moving away from a risks and rewards approach and towards a model based on performance obligations and transfer of control. This 5-step framework is much closer to IFRS 15, meaning many entities will need to revisit their existing policies, particularly where contracts include multiple elements, variable pricing, or customer incentives. For some organisations, especially those in telecommunications, professional services and retail, the timing of revenue could change quite noticeably. These sectors often deal with bundled arrangements, discounts and other complexities that require more judgment under the new model. The revised standard also brings an uplift in disclosure expectations. Entities must provide clearer information on how revenue is measured, how performance obligations are satisfied, and the drivers behind movements in contract balances. In transition, entities must can choose between the full retrospective and the modified retrospective approaches. Each option has its own practical expedience and disclosure requirements, so planning ahead is essential to minimise disruption. Overall, the updates are intended to enhance clarity and comparability across financial statements, but applying them effectively will demand thoughtful analysis, system readiness and robust documentation. So if we look at the 5-step model in brief to begin with, this slide gives a high-level overview of the 5-step model. This model ensures that revenue is recognised in a way that reflects the economic substance of what the business actually delivers, not simply when cash is received or when invoices are issued. It begins with confirming that a valid contract exists, followed by identifying exactly what goods or services the business has committed to provide, the performance obligations. We then assess how much consideration the business expects to receive for fulfilling these obligations, including any variable or uncertain elements. Where a contract contains multiple performance obligations, the total transaction price is allocated to each obligation based on the relative value of its individual components. Revenue is then recognised not at the point of invoicing or cash collection, but when or as the business satisfies each performance obligations. This may occur over time or at a specific point in the time, depending on the nature of the goods, services delivered. This principle-based control focus approach underpins how revenue is assessed under FRS 102. So step 1, revenue can only be recognised when a contract meets specific criteria. This step is always about confirming whether we actually have an enforceable agreement that creates rights and obligations for both parties. For a contract to exist, all of the following must be present. So approval by both parties. This could be written, electronic, or in some cases implied, but there must be clear agreement. Clear identification of each party's rights. What goods or services the business must provide. Clear payment terms. How much, when, and under what conditions the customer will pay. And commercial substance. The arrangements must have real economic impact for the business. And finally, probable collectability. The customer has the ability to and intention to pay. If a contract meets these criteria, revenue recognition can begin when performance obligations are satisfied. If the contract does not meet this criteria, any cash received is recorded as a liability, not revenue. Revenue can only be recognised later if the contract criteria becomes satisfied. If the criteria are never met, revenue is recognised only at the point where the business has fully performed and consideration becomes non-refundable or the contract is terminated. This assessment is crucial because it prevents premature revenue recognition and ensures we only account for revenue from contracts with genuine enforceability and economic substance. Even though Section 23 it doesn't explicitly state that contracts may be oral or implied, The underlying definition is consistent with IFRS 15, so in practice, oral or implied contracts can meet the criteria, but documentation and evidence are essential. This step requires judgment, especially in industries where agreements are less formal or where work begins before paperwork is finalised. Moving on to step 2. In this step, we focus on identifying exactly what the business has promised to deliver to the customer. These promises, the performance obligation, forms the basis for how revenue will later be allocated and recognised. A performance obligation is a distinct goods or service, or a series of similar goods or services that the customer can benefit from in its own or together with other readily available resources. To be distinct, it must meet 2 tests. The customer can benefit from it independently, and it is separately identifiable from other items in the contract. Where these conditions are not met, the goods or services are treated as a single combined obligation. Indicators that something is not distinct include significant integration, for example, when components are combined into a single output for the customer, significant customization or modification, making the components inseparable, or significant interdependence between the deliverables. Another key point, warranties that are required by law. For example, basic product safety guarantees are not treated as a separate performance obligation. This step often requires judgment, particularly where the contracts include bundle services, customization or technology components. Section 23 is aligned with the principles of IFRS, but is less prescriptive in certain areas, meaning businesses have more flexibility, but also greater responsibility to apply consistent, well-documented reasoning. Accurate identification of performance obligation is essential because it directly affects how the transaction price is allocated and when revenue can be recognised. Step 3 then, determining the transaction price. In this step, we determine the total amount of consideration the business expects to receive for delivering the promised goods or services. Importantly, this excludes any amount collected on behalf of third parties, for example, VAT, sales tax, or agent pass-through arrangements. A key part of this step is dealing with variable consideration. Variable consideration can arise from discounts or rebates, volume-based incentives, refunds or returns, penalties, performance bonuses. To estimate variable consideration, entities must choose one of 2 methods. Expected value method, so a probability-weighted calculation, suitable when there are multiple possible outcomes. Most likely amount method, a single most probable outcome, often used when the variability relates to binary events, for example, a bonus achieved or not achieved. Whichever method is chosen must be applied consistently within each contract. Variable consideration can only be included in the transaction price if it is highly probable that doing so will not result in significant revenue reversal when uncertainties are resolved. This constraint is critical for avoiding overly optimistic or premature revenue recognition. Entities must reassess transaction price estimates at every reporting date and update for changes in circumstances or new information. Because of the level of judgment and continual reassessment required, businesses need robust systems and processes to track variable elements and update estimates accurately. Accurately determining the transaction price is essential as it forms the basis of allocating revenue for each performance obligation in the later steps. So a quick example for this, a wholesaler supplier offering volume rebates. So a manufacturer sells products to a retail chain under the following terms. So list price £100 per unit. Annual purchase volume over 50,000 units and the customer would get a 5% rebate. Annual purchases volume over 100,000 units and you'd achieve a 10% rebate. And the rebates are settled at the year end. So initial expectation, based on past behaviour and forecast, the manufacturer expects the customer to purchase around 80,000 units. So the transaction price assessment, the expected rebate level falls in the 5% bracket. So the rebate is a variable consideration. Using the expected value method, the manufacturer estimates the likely rebate amount because it's highly probable that recognizing revenue based on 5% rebate will not lead to a significant reversal later. This estimate is included in the transaction price. And then you have ongoing reassessment then. If sales accelerate and the customer purchasing trends indicate that a 10% rebate tier will likely to be met, the manufacturer must update the transaction price and adjust revenue on a prospective or cumulative basis as required. This example highlights how variable consideration directly affects the transaction price and how critical continuous reassessment is throughout the contract term. Moving on to step 4, allocating the transaction price. Once we know the total transaction price, the next step is to allocate it across the performance obligations identified in the contract. The principle here is simple. Revenue should reflect the value of each distinct goods or service the customer is receiving. So allocation is based on the standalone selling price of each performance obligation. The price the entity would charge if each item was sold separately. If observable selling prices exist, these must be used. If not, the entity estimates standalone prices using one of 3 methods. Adjusted market assessment, looking at comparable market prices. Expected cost plus margin, estimating the cost and adding a reasonable profit margin, or residual approach, used only when the prices are highly variable or uncertain. Section 23 is broadly aligned with IFRS, but is less prescriptive, especially regarding how discounts or variable consideration should be allocated. This allows entities more flexibility to apply judgment and reflect the commercial substance of the arrangement. For example, discounts may be allocated proportionally across all performance obligations, or specifically to a particular obligation if that better reflects the economics. Once the transaction price has been allocated, the amounts are fixed and not remeasured. Any subsequent changes in the transaction price are recognised in the period of adjustment, without reallocating in previously assigned amounts. Contract modifications are handled depending on the nature of the change. Some are treated as separate new contracts, and others adjusted to the existing contract allocation and revenue going forward. Accurate allocation is critical because it drives how much revenue is recognised at each stage of the performance, ensuring that financial results are accurately portray the economics of what the business delivers. And then finally to step 5. In the final step, revenue is recognised when control of the goods or services transfers to the customer. This can happen either at a point in time or over time, depending on the nature of the performance obligations. So over time revenue recognition, revenue is recognised over time when any of these conditions are met. The customer simultaneously receives and consumes the benefits as the entity performs, for example, cleaning services, outsourced payroll, IT support. The customer controls the asset being created or enhanced. For example, this is constructing an extension to a customer's premises. The asset being created has no alternative use, and the business has an enforceable right to payment for the work completed to date, common in custom manufacturing, bespoke design, or specialised engineering contracts. To measure progress, entities use output methods, units delivered, milestones achieved, surveys of performance, or the input methods, costs incurred, labour hours and materials consumed. The method must show performance accurately and be applied consistently across the life of the contract. Point-in-time revenue recognition. Revenue is recognised at a single moment when control passes to the customer. Indicators include transfer of legal title, transfer of physical possession, transfer of significant risks and rewards, customer acceptance, and an unconditional right to payment. This is typical for standard product sales, retail transactions, and one-off equipment deliveries. Licensing agreements. Licenses require careful assessment. So right to access an intellectual property over time. Revenue then is recognised over time. For example, access to software with updates included. A right to use the IP as it exists at that point in time, the licence is granted. That revenue is recognised at point in time. So perpetual software licenses without any updates. So there's a key difference between those licensing agreements. The key principle, the method chosen must reflect actually a transfer of control, be applied consistently and provide users of the financial statements with a true picture of performance and revenue timing. So an example, a construction firm building a custom warehouse. A construction company signs a contract to design and build a bespoke warehouse on the customer's land. So here's the assessment. The asset is being constructed on the customer's premises. so the customer controls the asset as it's built. The warehouse is custom designed and cannot be redirected to another customer, so there's no alternative use. The contract provides an enforceable right to payment for the work completed to date if the contract is cancelled. So the outcome, the contract meets the criteria for overtime revenue recognition. So the measuring progress, in this instance, the company chooses an input method, so allocating revenue based on costs incurred relative to the total expected costs, because this reflects progress towards completion. So as construction progresses, revenue is recognised monthly on a percentage completion, cost and margin follow the same pattern, estimates are updated at each reporting date. This ensures revenue reflects the economic substance of the work performed and avoids large point-in-time spikes in profit. We will now move on to a couple of bit more detailed examples. So example 1. So Ben, a public limited entity, enters into a contract with a customer that contains 2 performance obligations: to sell a machine and to provide 12 months worth of technical support. The contract price is 1 million. The machine has a standalone selling price of 900,000. Ben does not provide a standalone service contract for this particular type of machine. It makes a gross margin of 60% on other service contracts and estimates that it will incur costs on the contract of 120,000. So how much of the transaction price should be allocated to each performance obligation? So the selling price of the machine is 900,000 based on observable evidence. There is no observable selling price for the technical support. Therefore, the standalone selling price needs to be estimated. So a residual approach would attribute 100,000 to support. However, this does not approximate the standalone selling price for similar support services, which normally make a profit. A better approach for estimating selling price of the support would be the expected cost plus margin approach. So based on this, the selling price of the support would be 300,000. So the 120,000, which they stated it would cost, and then you add the margin because they said they made 60% margin. The total of the standalone selling price of the machine and support is 1,200,000. So the 900 and the 300 added together. However, total consideration receivable is only 1 million. This means the customer is receiving a discount. So this discount should be allocated across all performance obligations. So the transaction price allocated to the machine should be 750,000. So that's the 900 divided by the 1.2 million. And the transaction price allocated to technical support in the same manner is 250, which is a 300,000 estimated divided by the 1.2 million. So revenue would be recognised when the performance obligations are satisfied. So as you can see from that example, we do need to look into how the income streams are separated out. And our final example for today then. So Llinos Limited is a company operating in the IT sector. The following describes issues affecting draft financial statements of Llinos Limited for the year ending December 25. During the year ended December 25, Llinos started selling a package of bookkeeping products for sole traders such as plumbers and electricians. The package consists of a laptop, a printer, a 12-month software license, and 12 months of help desk support. The selling price of each package is £1,080. The hardware, the laptop and the printer, on its own normally retails for £700. The software license for £300 and the help desk support £200. So Llinos sold 100 of these packages in the year to December 25, with the average date of selling 30th of September 25. So the company credited its sales value of the packages of 108,000. So revenue from contracts with customers, revenue should be recognised when the performance obligation is satisfied. So a package, bundle of goods and services sold, then the components of the package should be identified as separate performance obligations. The transaction price should be allocated to the performance obligations in relation to the standalone selling prices. And each performance obligation should be measured and recognised separately. So if the total of the fair values exceeds the overall price of the contract, the same discount percentage should be applied to each separate component unless specific discount rates are known. So in this case, the package with a retail price of 1,200 has been sold for 1,080. So a discount of 10%. So the components of the package should be split out and accounted for as that. So the revenue of 63,000, so it's 700 each, and it's and then you take 90% to get the 10% discount off, and you times by 100 sold. Same thing then with the software and the hard disk support. There's a 300 and a 200, and then you times by the 90%. So total revenue for the year ending December should therefore be 74,250. And the statement of financial position then should show a contract liability in current liabilities of 33,750. So it does show how different your accounts could look in the future when we debundle these different elements. And now over back to, I've got another one bit left to do, on other accounting considerations then for the revenue recognition. So this just summarises some more complex areas. We're not going to go into in depth today, but just summarising them. So contract modifications. First, contract modifications. These can affect scope, price, or both. If additional goods or services are generally distinct and priced at their standalone selling prices, we treat the modification as a separate contract. Where this isn't the case, we adjust the existing contract. Warranties. Warranties fall under Section 21 unless they provide additional service beyond assuring product quality. If they do, they become acceptable performance obligations and need allocating revenue. So therefore, if you give them an extra warranty and they've paid for an extra warranty above the normal warranty, then you need to consider the 5-step model for that. Non-refundable upfront fees. Upfront fees can look like revenue, but usually don't reflect a separate performance obligation. So deferred and recognised over the period we provide the underlying services. Customer options for additional goods services. If an option gives a customer material right, for example, discounting future purchases, that right itself becomes a performance obligation. Principal versus agent is all about who controls the goods or services before transfer to the customer. Indicators include inventory risk, discretionary in pricing, and being responsible for delivery. Other complex arrangements might need to be considered. Bill and hold requires to assess whether control is transferred even though delivery hasn't occurred. Consignment arrangements, customer acceptance clauses, repurchase agreements may not be sales at all. And these areas often require judgment and documentation. Getting the substance of the arrangement right is key to accurate and compliant revenue recognition. And then finally, on revenue recognition, Section 23 includes 2 transitional routes, and entities should choose one that best balances accuracy and practicality. So under the modified retrospective approach, prior period comparatives remain as they were, and instead an opening reserve adjustment is made. This reduces the workload significantly. Alternatively, the full retrospective approach restates the prior periods. This gives cleaner comparability but can be more resource intensive. Both routes allow practical expedience. The most commonly used are not restating completed contracts and grouping historic contract modifications together rather than unpicking them individually. These expedients are particularly helpful for entities with high volume or long-term contracts. On transition, disclosures must clearly explain which method has been chosen and why. Entities also need to quantify the effect on revenue, profit, and equity. Users of the council to understand what has changed and the reasoning behind these changes. So, successful transition requires planning. It may impact financial metrics, tax position, and contractual arrangements, such as covenants or performance targets. Systems may need updating to capture contract data, and staff need training to ensure consistent application. Communication with boards, lenders, and other stakeholders is critical to avoid surprises. Early adoption is allowed, but only when relevant periodic review amendments are applied together. And overall, a structured approach can help ensure a smooth and compliant implementation. And now back to Harri for the lease accounting.
Brilliant, thank you, Llinos. So obviously, the way I sort of see it, if you're impacted by the revenue recognition side, it's probably going to be the bigger part of what you've got to deal with. So I think probably only about 10 or 20% of my customer base are going to have to worry about the revenue recognition side. Most, the way they're doing it now is fine. But for that 10 or 20%, the revenue recognition is going to be a big deal, trying to do some of those calculations and understanding those, particularly the longer term contracts. So if that has impacted on you, it's something you need to focus on. If it hasn't, that's good news. The second bit of the change, lease account, which I'm going to talk about, it's sort of the other way around. I think this is probably going to impact 80% of businesses, but hopefully the real world implications will be a bit less, albeit there's still going to be a chunk of work potentially to do. And in some cases, I think a bit of work to do, even if it's not going to have an impact on the accounts. So to jump into, as I said at the beginning, we've got a mixture of accountants and non-accountants on the call. The accountants, depending on how old you are, will probably remember doing your accounts and having to wrestle with the definition of what is the difference between what's called a finance lease and an operating lease. So at the moment, we have two different types of lease, and trying to looking at different tests, and the tests have changed over the years. It was one of those tricky bits of the exam questions that lots of us struggle with, is to try and work out which sort of lease is which. So the headline as to the change on leases is that, which will be celebrated certainly by some accountants, is that differential is gone. So whereas at the moment we've had a finance lease and an operating lease, the good news, if you like, is that operating leases are no more essentially. And once these rules have come in, everything will be treated as a finance lease. So what that means is that whereas at the moment you may be, renting an office and just putting the rental payment through your accounts as a rent expense every month. Going forward, if you've got a long-term lease on that office is going to sit as an asset, and the flip side of that, you will have a liability on your balance sheet. So that's what I'm going to sort of cover off in the next 10 or 15 minutes is how those rules are going to come in. So the first thing, as you can see on the screen there, is you probably need to define what a lease is, and the technical definition is there. So conveys the right to control an identified asset for a period of time in exchange for some consideration. I think the first thing you need to sort of understand is that some leases are easy to spot, some are less easy to spot. So but I think probably a good place to start is look through your P&L. If you've got regular payments of a similar amount going out to the same organisation on a monthly basis or possibly quarterly, there's a good chance that there's a lease in the background there somewhere. So you probably need to pull those agreements and try and understand, is there a lease in place in the background? The second point I would make, though, is an identified asset is a critical term. So I've certainly got a couple of customers who've got some arrangements. So one, for example, is they pay it's an annual fee, albeit it pay monthly, and then they can use a sort of a pool of plant and machinery as and when they need it. So they can, I think, it's give 24 hours notice, and then next day turn up and pick up a digger and use that for a few days, and then the next week it might be a dumper truck they need, so they can grab that. So that wouldn't be a lease because there isn't a specific asset named in the contract. It's essentially an agreement to have an access to a range of assets. So it's going to take a little bit of thought and an understanding, is there actually a lease there or not, and then a decision will be made as to whether it should come onto the balance sheet. So in terms of what you can do now, if you're a December or March year end, we don't really want to be going through this exercise ideally in 2027, trying to identify leases and do all the calculations. If you're a simple business and you've got one or two, it's going to be an hour's work, if that, hopefully. But if you're an organisation that may have hundreds of leases, and we've certainly got many of them, and at the moment a lot of them have been treated as operating leases, this could be a good few days, if not a week or more's work to identify them, find the contracts, and do the calculation. So it is well worth, I suppose, preparing that register of leases now and getting ready for it. So just again, a quick, we've touched on this briefly at the beginning, but why are we making the changes? It's sort of to bring us into line with international accounting standards. The idea behind that is improved transparency. So at the moment, if you have got an entity that's treating most as finance leases and another as operating, their accounts would look very different. So hopefully it will make it easier for us all to compare organisations with each other. And, I'll grant them just about, I think, that it does simplify things only having one type of leases rather than two. Although the fact that they went for the more complex one of the two makes mean it is going to be more work for a lot of accountants, unfortunately, trying to get it right. So I'll just about give them the third one. So what's actually going to do? So essentially, as I said, you're gonna now recognise a lease on a balance sheet. So if I give a simple example, so if you currently rent a building or rent an office, and let's say that you're paying them £20,000 a year in rent payments. At the moment, very often those payments would just go through £5,000 every quarter, and that would just go through and hit the P&L as a rent expense. So what would change now is we'd look at that 5-year lease and say, well, right, it's the total liability over the 5 years is 100,000. And so I'll come on to discounting in a moment, but at a very simple high level, you say, right, so we're now going to bring an asset onto the balance sheet of 100,000 and a liability of 100,000, which is the future payments you've got to make that lease. So say it's going to make the balance sheet look very different. And that asset, it's called a right of use asset or an ROU asset. So normally we show them separately to your other owned properties and plant machinery. But you will have an additional fixed asset on your balance sheet called a right of use asset as a result of these changes. If you've got for example, that simple 5-year lease on a building. So the lease liability then is measured as I say, the present value of lease payments. So some of you will have done discounting before, but if not, the theory is that the value of that final £5,000 rent payment you make in the last quarter is actually less than what the value of today's first payment is, because money diminishes in value over time because of inflation. So you need to factor the impact of that into those leases. So the actual value of that lease wouldn't be 100,000 on your balance sheet on day one. It would probably be something like 95,000, because you'd factor in the diminishing value of income over the life. But in simple terms, you'd end up, as I say, with an asset on your balance sheet of, let's say, 95,000, and then a lease liability of 95,000 on the other side. But that is a very, very simple example. There's quite a lot of other bits that we need to factor into those figures, but we're not going to cover off all of that today, because, as I say, it's we'd be here for an hour or two to go through it all. So in simple terms, the right of use asset there is measured as the initial lease liability plus any sort of adjustments if you paid legal fees on the lease or spent money doing up the asset and paid for those direct. That would all be added onto the value of the right of use asset. And then the lease liability will be the payments you expect to make out, including any final payments. So if, for example, when you've moved into an office, you spent, £20,000 putting partitions throughout the office, and the lease says you've got to put it back to as you found at the end. If you're going to have to spend £5,000 at the end ripping out all of the partitions, you need to factor that in as one of the lease payments and part of the lease liability at the outset. So sorry, just flipping on to the next slide, getting my mouse in the right place. So, the example I've given there is a very simple one. But I mean, the truth is that no leases actually look like that in real life, or very few. And the truth is most leases will have things like break clauses in them. There will be things about dilapidation. It's not just the fact you've got to put the building back to as you found it, but you've probably got to make good any repairs as you go along. And I've certainly got some leases with customers that are fairly complex, and the rent you pay is linked to the sales you make, and some are flat, some have fixed rental increases based on RPI or CPI and other things like that. So as I say, whilst a basic lease would be very straightforward to calculate, the reality is most leases are a bit more complex than that and do take a bit more work. So again, another reason not to leave this to the last minute. And similar to what Llinos was saying about the revenue recognition, there's going to be some judgment involved. So again, if I gave an example of if you sort of signed a 10-year lease with a 5-year break on a new office and agreed to pay £100,000 a year in rent, well, do you treat that as a 5-year term or a 10-year term? And they're not always going to be easy judgments to make. And the conversation we've been having, if you've spent £1 million refurbishing your new office at the start of those 10 years, well, you're probably not going to break that lease after 5 years, and it's right to treat it as a 10-year lease. But if you haven't had as much of a refurb, or you know that you're growing at such a rate that there's a reasonable chance you're going to have to move offices before you get to the 10 years and probably enact the break, you might choose to do it over 5. So it's not, as I say, there's not going to be, just black and white answers to a lot of these questions. We are going to have to spend a bit of time looking at the facts, and the facts might change. As I say, it might be that you took on a lease fully intending to stay there for 10 years, but after 3 years, something had happened that meant that you needed to move on sooner, and you suddenly realize we are going to change and break the lease, and all of a sudden you're going to have to make quite a lot of accounting adjustments to factor all of that in. The good news, and there is some good news with these changes, so that there are some things which will make life a little bit easier. So the first is that short-term leases are essentially exempt, i.e. you can basically treat them like an old-fashioned operating lease and just put the payments straight to the P&L. So if you've got a lease that's less than 12 months old, you can just put that through as a cost. You don't have to go through the whole rigmarole of capitalizing it and depreciating the asset and accounting for interest, etc. And secondly, low value assets are exempt. So the standard doesn't really define a low value asset, but it does tell you what isn't a low value asset. So things like vehicles, plant machinery, property is all certainly going to have to go onto your balance sheet. But for example, things like a mobile phone contract almost always includes a lease, because you're normally leasing the phone as well as sort of buying airtime from the provider. But things like mobile phones, probably laptops and small pieces of equipment would not have to be treated and capitalized. You can just stick those through as operating expenses to make life a bit easier. And as it says there, benefit of that is you can just write them off in a straight line, and it will reduce the accounting burden somewhat. I'm going to touch on these briefly, but I don't think it's as relevant this to sort of most commercial businesses. If you've got peppercorn and below market value leases, that can potentially be an issue as well. It's less common in commercial businesses, but yeah, if you do have any of them, don't ignore them and think, oh, that's fine. We're not really paying much for that lease. Keep it on there, because there's a risk potentially you would have to actually account for it at its full market value and bring in the differences as a donation. More of an issue really in the charity and not-for-profit sector, because a lot of the time a charity might be given a building by the local authority on a peppercorn rent, as a way of support essentially. So those sort of things, if you've got anything like that that affects you, it could be the same thing, but from a parent company overseas. Then bear it in mind that might be an issue, and raise it with us sooner rather than later. So, as I said, I've given a very high level as to sort of what the impact's going to be. Some of the things I think you need to be thinking about now, and whether it's going to have an impact, is covered on this slide. So it is going to grow your balance sheet. So potentially these extra assets could, for example, push you over the limit into having an audit. So if you've got a lot of operating leases or a lot of leases, it's worth getting on with this exercise earlier, so you can understand, is it going to have an impact on the size of your balance sheet, or what's going to happen? In simple terms, it's going to increase your fixed assets, but also increase your liabilities, and some of that liability will be short term. So I would expect most balance sheets to actually see a reduction in their net current assets. And because at the moment a figure, so if I take a property lease that's going through as an operating cost as rent, that is essentially now going to change. It's all going to go down to depreciation or interest. So you're going to have the depreciation on the asset and the interest on this loan. So your EBITDA, so for those who are not aware of that, that's the earnings before interest, tax, depreciation and amortization. We actually expect the EBITDA to go up, but your net current asset position to come down. And for many of you, you'll be thinking, well, what does that matter? Who cares? The people who may care is your bank. So if you've got lenders who have got loan covenants in place that are impacted by some of these ratios, it's certainly worth starting to model what impact is going to be now. And if it's a negative one, certainly I'd be trying to have conversations with the bank before we do the next set of accounts. Because the worst case is they ask you to prepare your accounts under the old rules just so they can compare it, which we certainly have to do in the past with other clients, and it's just extra work for limited benefit. So as you say, if you think these changes are going to have an impact on your lending and your covenants, start conversations with the bank this year. I wouldn't wait until the accounts have been finished, because the last thing you want is a covenant breach. And a few sort of quick, again, relatively good news. Similar to what Llinos is saying about on the revenue recognition, the good news is we're not having to go back and restate lots of sets of accounts for all of these changes, because you will have leases which have probably been in place for several years. So it would be a real pain in the neck to have to go back and start accounting for those leases from day one. Essentially, you can bring them in from the date of transition for what's left on the lease term. And I say there's no need to go back and restate the previous year's accounts. You'll bring the asset in essentially on the day of transition. So if you're a March year end, you'd effectively work out the position on the 1st of April 2026, and then that transaction will be brought in, the right of use asset onto your balance sheet, the new liability, and any difference between the two then will just go straight to your reserves. So it'll just hit your profit and loss reserve, and then it'll be accounted for under the new rules moving forward. So it's a relatively straightforward introduction of the new rules. I touched on it briefly earlier about this discount rate and the time value of money. Again, there's good and bad news here. The IFRS rules are you've got to use the rate implicit in the lease. Well, I'll be honest, we don't do huge numbers of those accounts, but we've never had anyone who's managed to have a good enough landlord-tenant relationship to manage to get to that bottom of that number. And sometimes I'm told it's in the lease, there's a figure there, but I've never seen it. So normally you go for an incremental rate of interest, and that's generally what, if you go to your bank and you say, right, if we were to buy this building, what sort of mortgage would you give us and what would the rates and terms be, and you can sort of work out a discount rate based on that. FRS 102 has luckily brought in another option, because I think there's lots of entities that don't really borrow money, so they'll lease property, but they don't generally have a strong enough relationship with the bank to run some calculations for them just so they help them get their accounts right. So you can now just use a general obtainable borrowing rates, which may be a more sensible number. But those discount rates will have quite a big impact on the numbers. So if you're not sure, or you're nervous whether you pick the right one, engage with ourselves or your accountants early, just to make sure you're using an appropriate rate and something which is going to be acceptable. And if you are an audit, if you're one of the clients that needs an audit, keep the evidence of why you've come up with that number, because the auditor probably will need to see some evidence for where you've got your discount rate from for when they're doing the reworking of those calculations. Tax, it's good and bad news on tax. I mean, the tax rules aren't 100% confirmed yet, but the positive news as I see it is that the tax rules are going to broadly follow the old rules. So we don't see these changes having a huge impact necessarily on what you're going to have to certainly pay out in tax or the relief you're going to get. If anything, the tax will hopefully improve slightly, because when you work through the calculations, your depreciation and interest figure is probably going to be slightly higher in the early years than it is in the later years. So there may actually be a slight improvement in when you get your tax relief. But the headline is there's not going to be a massive change to the amount of tax you pay as a result of these changes. So just a summary of the key takeaways. As I say, it's going to impact most businesses, the leases side. They're going to have to go onto the balance sheet and a corresponding liability. Now is the time to start getting ready, try and identify the leases, look at what systems you've got to identify leases, and where necessary, train staff, find templates to start to do the calculations, and if you've got lenders or shareholders that are going to be impacted by all of this, start chatting to them now so they know what's coming, and just plan for the transition. So as I say, if you've got low value leases, do yourself a favour, don't put them all onto the balance sheet, and then get ready for hopefully a smooth transition when the time comes. So that was it. Hopefully you've found that helpful. Hopefully, as I say, it's given you a high level indication as to the impact of those revenue changes and the lease changes. If there's any questions you've got, once you've sort of had time to digest it, please contact us, contact the partner or the manager on the job. We're more than happy to help walk people through the changes. But a huge thank you for listening to us today. I think just to be aware, I'm conscious we've gone through it fairly quickly and at a high level. We are going to be doing some more detail in depth webinars later in the year when we're a bit closer to the actual the times we're actually doing these detailed calculations. So, if you've got leases or revenue recognition issues which you need to cover off, please log on to one of those and we'll be more than happy to help. But thank you very much for your time this afternoon. We hope it's been helpful and we'll speak to you soon. Thank you.